Section 24. Finance terms and institutions. Leverage is maximizing the use of borrowed money. Most people cannot afford to buy a home with their own cash. That is why they take out loans from the bank. That is leverage. Appreciation. Seller's market is when there are more capable buyers than there are available properties, therefore the prices will rise. The gross national product is an accounting of the number of goods and services produced by the country in any given calendar year. When the GNP and the rate of employment rise, personal income also increases and home sales begin to rise. Most of the funds used by financial institutions that specialize in residential real estate are derived from the individual savings of depositors. Federal Reserve Board is a government-appointed organization which runs the central banks in the USA. When the Fed increases the cash reserve requirements, their goal is to decrease loan activity. In a tight money market, money is tight, therefore you will see more second trustees and sellers will have to carry back a second more often. Because money is tight, the banks do not have the ability to lend the full loan amount in one loan. Insurance companies Savings and Loan Associates is the biggest source for home loans and or residential financing. They have the most funds invested in real estate. Mortgage companies deal with loans that are readily sold in the secondary mortgage market. Private lenders are the main source for junior loans. Secondary mortgage market refers to the resale marketplace for existing loans. It is a market of packaged home loans that are resold as securities to investors. Major players are Fannie Mae and Freddie Mac. Loan-to-value ratio is the ratio of the loan to the lending value of a property expressed as a percentage. For example, the loan-to-value ratio of a loan for $90,000 on a home which costs $100,000 is 90%. The lower the ratio, the higher the equity. Degree of risk is the most important factor for a lender in determining whether or not to make a loan. In determining whether or not to make a loan commitment, a lender will examine the borrower's income, their character, and the property. Debt-income ratio is used by lenders as a loan qualifying tool. It is how much money you are bringing in as compared to how much money you owe. FICO score reflects a buyer's credit history. FICO is a credit score scale used by many mortgage lenders that use a risk-based system to determine the possibility that the borrower may default on financial obligations to the mortgage lender. Property is collateral for the lender because if you default on the terms of your loan, the property will be sold to recover the debt. The mortgage or trust deed is your agreement to pledge your home or other real estate as security. Substandard loans is a term for borrowers with a bad credit history, so they are high risk, therefore lenders try to minimize them. Interim loan is a short-term loan usually made during construction of a building. After completion of the structure, a permanent loan is customarily arranged. Take-out loan is a long-term loan. It is a permanent mortgage loan which a lender agrees to make to a borrower upon completion of improvements on the borrower's land. The proceeds of the loan are used principally to pay off the construction loan. Mortgage yield is an interest return that a lender gets from a mortgage. In a deed in lieu of foreclosure, a lender assumes any junior liens present on the property if he has accepted a deed in lieu of foreclosure. A request for notice of default is recorded in order to protect the beneficiary of a second loan. Usually priority of the loans is granted to the mortgage that is recorded first. So if the first is not getting paid, the second is not going to get paid back, so therefore they file the request for notice of default. Subject to. If a property were sold subject to an existing loan, the sellers would be primarily liable for the loan. Assume. If a buyer is willing to assume a trust deed and note, this would have the effect of relieving the seller of the primary liability on the trust deed. Payment is considered late. Payment is considered late if the lender receives it more than 10 days after the due date. Warehousing. Discount points is when a lender demands prepaid interest when a loan is negotiated. Each discount point equals 1% of the face amount of the loan. Document preparation charges is usually categorized as part of the loan origination fee. A loan origination fee, the charge you must pay to the lender for processing your mortgage. Federal Housing Administration. VA loan. With a VA loan, no down payment is required. It is a loan guaranteed by the U.S. Department of Veterans Affairs. VA loans are made to honorably discharged veterans or their unremarried widows or widowers. VA loans cannot be used to purchase rental property. You, however, rent the property later. CalVet loans use land contracts. As such, only equitable title is transferred to the buyer while the Department of Veterans Affairs retains legal title to the property in question. The buyer makes payments until fully paid off. Because there is no lender involved, it is the lowest closing costs. Conditional installment sales contract. Truth in Lending Act was designed to protect the borrower by requiring the lender to make a meaningful disclosure of credit terms to the borrower. The Truth in Lending Act would not cover agricultural loans. The right of rescission on a loan begins when loan documents are signed by the borrower. The APR is the cost of credit that consumers pay, expressed as a simple annual percentage. If the ad only states the APR, then other disclosures are not necessary. Right of rescission. The borrower has a right of rescission regarding the loan agreement until midnight of the third business day after the note is signed if the primary residence is used as security for the loan. This right of rescission is not applicable when the loan is used to purchase the borrower's residence.